Good morning, afternoon, or evening, and thank you for joining us today for Afriforesight's webinar, South African Mining Ripe for Extraction. In today's webinar, we hope to bring you some good news, particularly focused on mining and processing in South Africa. My name is Vinesh Chetty, and I'm Afriforesight's Head of Research. For newcomers to the Afriforesight Forum, we are the largest mining research house in Africa, and we have a multidisciplinary team ranging from economists to engineers. We provide forecasts for Africa's key mined and extracted commodities, as well as for major cost items required for mining and processing. While we will be brief today, we're going to try to cover as much as possible in a short space of time. All of the information which we provide today, as well as much further in detailed information, is available via our new digital research platform called Afriforesight Explore. And of course, our subscribing clients have access to the information through that platform. Today, we'll start off with Charles covering our macro environment as well as South African mining space. I'll then come back to cover the South African port and electricity environment before handing you over to Devon, who will cover South African smelting activity. And while you'll see a lot of positivity in all of those, we'll round out with Chinmay, who will cover how South Africa is exposed to Middle Eastern fuel issues. So if you are not a client, or if you don't have access to a particular aspect of our research, please do reach out to Sebastian Naidu, our Business Development Executive, or to Kelly Marthy, our Client Servicing Manager, at the email addresses on screen. On screen, you'll also see the address for the Afriforesight Explore platform, where we post daily notes, lots of information available, where, again, you can get access to many updated pieces of information. Please do join us over there. Just some housekeeping here. We will be answering questions at the end of the presentation. If you have a question, we ask that you submit it through the Q&A function. If you're watching us on a computer through Teams, up near the top center of your screen, you should see the Q&A button. Click on that, type your question, and we'll answer as many of them as we can at the end of the presentation. If you need to leave for some reason, you can also submit a question via email to Sebastian or Kelly. Finally, a recording of this webinar is being made and will be available later this week on our website, and clients can, of course, request a copy. I'm now going to hand you over to Charles, who'll take you through the macro environment. Charles.
Thank you, Vinesh. Good morning, everyone. South Africa has vast mineral wealth. We host the largest resources and reserves of PGMs, manganese, and chrome, and are the world's largest producers of each of these commodities. South Africa also has significant reserves of gold, iron ore, diamonds, vanadium, and coal. There are smaller deposits of copper and nickel, but these commodities are extracted mostly as a byproduct of PGM mining. But despite this embarrassment of riches in natural resources, because of logistics and power constraints, as well as economic, political, and regulatory uncertainty, the mining industry has been unable to realize its full potential. As a result, following a strong post-COVID recovery, economic output from the mining industry has essentially stagnated since. During that period, for example, being unable to capitalize on a surge in coal prices in 2022 due to a lack of rail capacity. To put that in context, in 2010, the mining industry contributed about 8.7% to South Africa's overall GDP. That was only 6.3% in 2025, suggesting an inability to keep track with even weak top-line growth numbers. The mining industry performance is also extremely erratic, with good quarter following bad. I also thought I'd point out that the industry is increasingly exposed to extreme weather events as climate change intensifies. For example, the large-scale flooding that hampered mining and especially PGM extraction in the first quarter of 2025. A clear symptom of the lack of confidence in South Africa's mining industry is the sharp drop-off in mergers and acquisition activity over 2025. What deals were made focused on copper and manganese, assets, as well as a consolidation of assets under one company, especially in the gold industry. But we now see better days ahead. Over the past 12 months or so, a surge in commodity prices, along with progress on power and transport reforms, as well as a more stable economic and political environment, has created opportunities for South Africa's mining industry to grow. There is still, however, concerns about policy uncertainty. Let me tackle each one of those in turn, starting with commodity markets, where each of South Africa's major commodity industries has got a positive story to tell. Chrome and manganese are still only a relatively small part of overall South African mining revenue, but both set a record for extraction and exports over 2025. South Africa's relatively high grade of iron ore also makes it sought after, especially in China, whose own grades are busy declining. Gold and PGM prices remain elevated after setting records earlier this year, and with the world increasingly in turmoil, gold and platinum will continue to benefit from safe haven demand. And even as the share of electric vehicles grow, ongoing, if lower, sales of internal combustion engines, as well as growing popularity of plug-in hybrid vehicles, will keep PGMs in the auto catalyst game for a while yet. So to coal, where India will remain an important outlet for SA's higher quality product to produce power, cement, and chemicals. The growth in electric vehicles and standalone batteries also provide opportunities for copper, nickel, and vanadium. Unfortunately, diamonds is perhaps the one industry that has its best days in the past. Recognizing South Africa's mineral potential is one thing, turning it into a pipeline of projects is another. According to Afriforesight's count, other than coal, there are very few projects in development or with development potential, largely as a result of a lack of exploration spending, which has plummeted from 6.2 billion in 2006 to only 73 million in 2024, less than 1% of global spend. But to kickstart activity, the Department of Mineral and Petroleum Resources, along with the Independent Development Corporation, started a 400 million fund to fund exploration spending, with Anglo American also chipping in 600 million. Half of that funding had already been allocated by the middle of last year, underscoring the appetite for exploration in the country. Second call for next applications finished in October last year. Perhaps the biggest factor pointing to an improved outlook for the South African mining industry is the progress made by both Transnet and Eskom in advancing reforms to tackle shortages in rail and power capacity. The operational and financial crises at the state-owned enterprises was a legacy of poor management, underinvestment, and poor cost control, corruption, and theft. In early 2023, the South African Reserve Bank estimated that load shedding was costing the South African economy up to 900 million rand a day. Excuse me. I'm going to leave it to Vinesh to expand on the progress made by Transnet and Eskom just in a after I finished speaking. Given the improvement at Eskom, South Africa is also on the cusp of a resurrection of its smelting industry after government agreed to discounted electricity tariffs to facilitate the recovery in what we believe is quite a sensible agreement. Again, Devin will dig into the details a little bit more later on in the program. A more stable economic and political environment is also creating a more conducive macro environment for our mining industry to operate under. Following a couple of dire years, improved power supply allowed South Africa to post just a modest improvement in economic growth in 2025. Not quite shooting the lights out and relatively slow compared to our developing market commodity producing peers such as Brazil, Indonesia, or even the DRC, it is certainly trending in the right direction, with more improvement expected in the near term. So to the political environment, where the Government of National Unity, formed after the May 2024 election, has just steadied nerves and provided some some needed confidence in the South African environment. Don't take my word for it. Over 2025, the rand strengthened by close to 10% in a sign of confidence in the country. Yes, the dollar weakened over the first half of the year, but improved confidence has certainly played a part. The rand also just about held its own in the war in the Middle East period, when the dollar was soaking up lots of safe haven demand, and the rand essentially shrugged off the renewed threat of impeachment against President Ramaphosa. It's not all unbridled good news, and the perception of South Africa's mining regulation, as measured by the Fraser Institute, has hit its lowest level ever, doing poorly in both a global and a sub-Saharan context. The government has made the right noises about improving policy, but the execution has been lacking a little bit. After a couple of false starts, the revised version of the Minerals Resources Development Bill now appears to be imminent. The initial draft version, gazetted in May 2025, failed to instill confidence, but it is hoped that this revised version, following extensive input by industry, will clear up some of the confusion about black economic empowerment and the licensing requirements for processing tailings, amongst other contentious issues. Likewise, the much talked about cadastre mining license system, which has been piloted in the Western Cape, is still missing in action. This system is essential to ensure the smooth operation of licensing, as well as providing clarity about mineral ownership and battling corruption. All told then, as long as government comes to the party in sorting out regulations sooner rather than better, we believe that the South African mining industry is poised for better days ahead. And on that note, I'll hand you over to Vinesh.
All right, I'm going to take us through the port and electricity, rail and electricity sides of things. Just before I get started on that, though, again, please, if you do have questions or comments, I ask that you click on the Q&A button, add a question there. As I said, we'll answer as many of them as we can later on. As Charles pointed out, Transnet and Eskom have had years of problems which have hurt South African GDP. And on the mining side, we have seen multiple mining companies, smelting companies, tell us that they have been constrained by rail and power problems. But despite those issues, we are starting to see improvements. Both Transnet and Eskom appear to have turned the corner. And now we are seeing that the private sector has a place to play as well. We've already seen what the private sector has done on electricity generation, and now we're on the cusp of seeing private rail operation in South Africa as well. And those look set to help continue these improvements going forward. If we start on the logistics side of things, when we look at rail volumes that you see over here on the left, these are for each year ended March, that is a Transnet year. We've seen that after years of rail volumes declining, we've started to see Transnet pick up those rail volumes. Now, we've seen Transnet say that they're starting to do things. We're starting to see much of those improvements bear fruit now. And while we don't yet have the official 2026 number, we have seen that Transnet has seen a 9% increase in ship arrivals. So we expect that rail and container volumes will pick up as well. Now, rail volumes tend mainly to help your bulk mineral miners. Those are your iron ore players, your coal miners, manganese, and chrome ore. But again, it is worth remembering that increased rail throughput helps everyone. When you look on the container side, again, for mining, that's mainly going to be your chrome concentrates. Some of that is exported in containers, as well as some of our copper concentrate is exported in containers. But it's worth remembering that these rail lines and container lines both help imports and exports. So again, a lot of the materials being imported that our miners use are imported in containers. So again, improving the logistics helps everyone. Yes, bulk miners tend to get most of the enhancement, but overall, a better logistics system helps everyone. Now, the numbers you're seeing here, these are Transnet improvements. This is things that Transnet has done so far to improve things. But we're now seeing private operators. We are on the cusp of private rail in South Africa. Now, as I said, Transnet has improved, but they've brought us up to about 180 million tons per annum of rail throughput. They want to take us out to 250 million tons per annum by 2030. It's a 40% increase, 70 million tons per annum extra to be added. Where's that going to come from? Well, Transnet themselves see the bulk of that, about 50 million tons of that 70 million coming from private players. And the good news is that we now have 11 private firms that have signed rail access agreements with Transnet. So instead of a world where we just have Transnet running all the trains, we'll now have 12 players, 11 private ones plus Transnet. Now, those 11 private players still need trains because they don't have trains, but Transnet is looking to rent out some of their older train sets to those private players. But those private players have their rail access and are expected to carry the bulk of the increase. Transnet to increase some of the throughput, but most of the throughput coming from the private players. And we've seen what private rail can do. In many African countries, private rail already exists. And just over the border in Mozambique, we've seen what Grindrod, which is one of the private rail operators here in South Africa, one of the licensed operators in South Africa, what they've done with the Matola terminal over in Mozambique. They've taken large amounts of South African chrome. Actually, the majority of South African chrome today goes out via Mozambique, as well as much South African coal. Now, again, if South Africa can get its rail going, if we can see more rail from Mpumalanga down to Richards Bay, we expect that we'll see less going via Mozambique, and it can also allow more South African production, because we've seen South African coal miners tell us that they produce less because they can't get rail down to Richards Bay. Similarly, we've seen South African iron ore miners say we'd like to produce more in the Northern Cape, but we can't until we've got more rail down to Saldanha Bay. So again, as those private players come online, more rail access allows for improvement. Similarly, once we get the last piece of the rail completed down to Coega Port, we can see much more manganese exported that way. Similarly, more chrome via Richards Bay once we have more rail up and running. So that's the rail side of things. We expect to see improvements. The other improvement we have already seen is on the electricity side. So what you see here is Eskom's energy availability. You can see the green as basically power station uptime. And in 2026, Eskom has had about a 66% uptime on their power stations. And while it should simply be business as usual, Eskom has now seen a full year without load shedding. While that should be the norm compared to where we were in previous years, a full year without load shedding is a good thing. And that is, again, what you're going to see when it comes to Devon in a little bit, that Eskom now has excess electricity available to help with smelting. Because while a lot of this uptime comes from improved maintenance, which has helped keep the lights on, it's worth remembering that some of the lack of load shedding over the last year is low electricity demand from Eskom. Eskom today produces less electricity than it did in 2007, back when electricity was much cheaper. Again, Devon will go into more detail a little bit later. But again, as far as the general upswing, Eskom has seen an increase in power station availability and has gone a year without load shedding. But it's worth remembering that it is not Eskom alone that has done this. Eskom has improved maintenance, has kept the power stations running, but we've seen a significant increase in IPPs. You see here in the orange, capacity, more capacity from private players. The IPPs are those utility-sized projects which sell electricity towards Eskom. They are overwhelmingly renewable power, and the vast majority of that is solar and wind power, IPP side. We also see self-generation in the green. Now, some of this are the solar panels that you see on shopping centers, new housing complexes and the like, but a lot of it is also on mines themselves. In 2025, mines had 1.8 gigawatts of self-generation, and they've got another 1.7 gigawatts in the pipeline coming online. And much of that has again been improved government policy that Charles talked about. Previously, there was a cap on how much self-generation you could do. When that cap went away, instead of being capped at 10 megawatts, now you can self-generate without limit, and that's seen these miners generate huge amounts of electricity. And while that electricity is for the mines to use, what it does is it means that the mines are not using as much Eskom electricity, which leaves more electricity available for you and me, and for those smelters, which Devon's going to get into in a little bit. So more renewable power, both from the utility level IPPs as well as from the miners themselves, has helped to keep the lights on, and again has now created a point where Eskom is in a surplus. Eskom has built out the last of their coal power stations. Medupi and Kusile are fully online. That's probably the last of the power stations. Eskom's plans, though, previously called for significant cuts in coal-fired power. We now see Eskom keeping those coal power stations online through 2029 and has pushed out the closures through to about 2030. So again, lots more Eskom power available now than under previous plans, and that's part of what's seen them have this excess, which they're planning to help with more smelting tariff relief going forward. So I'm going to hand you over to Devon to take you through the smelting side. Devon, over to you.
While global attention remained focused on war, inflation, and fuel prices, important structural changes are currently taking place in South Africa's mining sector. One of the biggest is the renewed focus on beneficiation. In other words, processing minerals locally instead of simply exporting the raw ore. This conversation largely faded over the last decade as those high electricity costs became through, industrial competitiveness weakened, and smelter closures accelerated. But recent developments suggest that discussions are returning in a more serious way. And importantly, it's no longer about mining production. Sorry, it's not only about mining production, but it's increasingly about industrial competitiveness, strategic electricity pricing, and preserving downstream capacity. For decades, South Africa had a major industrial advantage: cheap and reliable electricity. And this allowed the country to build globally significant ferrochrome, manganese, alloy, and steel industries. South Africa wasn't simply mining minerals, it was processing them. But over time, the economics changed drastically. Eskom's tariffs rose sharply, electricity availability and reliability deteriorated, and logistics bottlenecks also intensified. Looking at this graph, electricity prices increased almost ninefold since 2008 levels, fundamentally changing the economics of energy-intensive industries like ferroalloys and steel. At the same time, Chinese processing capacity became increasingly competitive and started importing South African ore for beneficiation. The result was a structural shift away from local processing towards raw ore exports. South Africa remains resource rich, but steadily lost downstream industrial competitiveness. Chrome is probably the clearest example of what's happened to beneficiation in South Africa. As this graph on the left shows, South Africa's chrome ore exports increased drastically over the last decade as China increasingly imported raw ore for their domestic processing. And at the same time, the ferrochrome exports and local ferrochrome production declined as those rising electricity costs steadily eroded South Africa's smelting competitiveness. Over the last several years, the ferrochrome industry steadily shifted from expansion mode into survival mode. Furnace suspensions accelerated, including closures at operations like Wonderkorp, Boshoek, and the Lion smelter, while China increasingly beneficiated South African ore. That's why the recent restart of the Lion smelter earlier this year may represent the first meaningful stabilization signal that the sector has seen in years. And this is where the recent developments become extremely important. Eskom concluded a proposed long-term 62-cent per kilowatt-hour tariff framework with Samancor Chrome and the Glencore Morafe Chrome venture, following earlier emergency tariff relief measures. Before then, NOSA approved an interim relief tariff of about 88 cents per kilowatt hours after retrenchment processes were initiated in the ferrochrome sector. What makes the latest framework especially significant is that Eskom now appears to view smelter closures as a direct commercial risk to utility itself. Eskom argued during recent NERSA hearings that retaining ferrochrome demand is necessary to support electricity sales and justify long-term coal supply agreements to existing generation capacity. The framework also includes burden sharing and upside sharing mechanisms. Smelters commit to maintaining operations and demand under the take and pay agreement, while Eskom can recover some upside if profitability improves in the future. So this is increasingly being positioned not simply as discounted electricity, but as a strategic industrial partnership framework. Government has also indicated that they want more furnaces and smelters brought back online progressively as electricity availability improves. And if smelting activity increases again, the benefits extend well beyond just ferrochrome producers themselves. The more beneficiation would reduce pressure on South Africa's already strained rail and port infrastructure because less bulk ore would need to be exported. It would also create additional domestic sales options for the miners, potentially allowing upstream mining operations to ramp up production more confidently. So the potential recovery story here is not only for ferrochrome margins. It could reshape the broader mining, logistics, and industrial ecosystems. So similarly, manganese followed almost the exact same structural trend. South Africa holds most of the world's high-grade manganese resources, yet local manganese alloy production steadily weakened as those electricity costs increased and smelter competitiveness deteriorated. As seen on these graphs, manganese exports increased strongly over time, while the alloy production and exports moved in the opposite direction. Over the past decade, South Africa progressively lost smelting capacity as furnaces became increasingly uneconomic relative to overseas processing markets. The latest example is Transalloys, effectively South Africa's last operational manganese smelter, which is considering closure and plans to cut up to 600 jobs because of the soaring electricity costs. That is strategically significant because it highlights how close the country is to losing its remaining manganese alloy beneficiation capacity altogether. And importantly, the response from Eskom suggests that they are increasingly recognizing the broader industrial risk associated to further closures. Eskom is also reportedly exploring lower tariffs, electricity tariffs for Transalloys, and has requested NERSA approvals. This is important because it suggests the tariff intervention strategy may extend beyond ferrochrome into manganese and potentially steel as well. And again, if more manganese smelting capacity can be stabilized and restarted, the benefits extend well beyond downstream processing alone. More alloy production would reduce the ore export volumes moving through an already constrained logistics system while simultaneously creating stronger domestic demand for manganese miners, and that could eventually support higher mining output and improve industrial optionality. In other words, beneficiation recovery could have a positive ripple effect across the entire manganese value chain. So the deterioration in beneficiation was not limited to ferroalloys. The steel sector has experienced something similar. ArcelorMittal South Africa announced the closure and wind down of their Newcastle and Vereeniging long steel operations after years of rising electricity costs, weak domestic demand, and as you can see, the growing import pressure. But the implications extend far beyond steelmaking itself. Downstream manufacturers increasingly argued that the weak domestic steel industry is damaging South Africa's broader fabrication and industrial ecosystems. And importantly, the effects have already started to feed back into upstream mining activity as well, when ArcelorMittal reduced and suspended portions of their long steel operations, African Rainbow Minerals subsequently announced that the Beeshoek iron ore mine would be placed on care and maintenance because ArcelorMittal would no longer be purchasing certain iron ore products from their operations. This is a very important example of how downstream industrial weakness can ripple back into domestic mining demand, employment, and regional economies. At the same time, there are still projects suggesting some investors see long-term beneficiation potential in South Africa. Projects such as the Musina Makanda Metallurgical Complex and the Changfang Electric Arc Furnace steel plant indicate that parts of the market still believe South Africa can remain competitive in downstream metal production under the right conditions. And importantly, Eskom is now indicating that future electricity tariff intervention discussions may prioritize ferroalloys as well as iron and steel. The government is also increasingly intervening on the trade side to protect domestic steelmaking capacity. Just earlier this month, South Africa raised import tariffs on a broad range of steel products, with duties ranging between 10 and 30% on these products. The move followed growing concern of these rising imports, particularly from China, and the mounting pressure this had on the producers. Importantly, government and South Africa's Trade Commission framed the tariff increases as a part of a broader effort to give the local steelmakers breathing room to invest, stabilize operations, and preserve industrial capabilities. And importantly, the current tariff increases may only represent the first phase of broader industrial protection measures, with additional safeguard actions and further tariff reviews currently under consideration. So when you combine the strategic electricity pricing, steel import tariff protections, and emerging beneficiation projects, it becomes clear that South Africa is moving towards a more industrial policy approach focused on preserving downstream capacity and rebuilding competitiveness. The broader objective increasingly appears to be preventing further deindustrialization while supporting strategic beneficiation industries. So just to round everything up, one of the most important development underway is that government and Eskom now appear to be treating beneficiation industries as strategically important again. Eskom tariff interventions framework is specifically aimed at preventing further smelter closures while protecting industrial capacity and jobs. Importantly, Eskom explicitly stated that ferroalloys, iron, and steel would be prioritized in future negotiated pricing agreements because of the severe structural pressure facing these industries. And this represents a major policy shift. For years, South Africa largely moved towards a market-based electricity pricing system, regardless of industrial consequences. Now the country appears to be shifting back towards strategic electricity pricing linked to industrial competitiveness and beneficiation preservation. And the broader economic implications could be substantial. What makes the current moment especially important is that beneficiation is no longer only being framed as industrial policy. It's increasingly being linked to electricity demand stability, mining growth, logistics efficiency, and also broader economic resilience. The key question is whether South Africa can stabilize conditions enough to rebuild downstream competitiveness. And if it can, beneficiation could quietly become one of South Africa's most important longer-term mining and industrial opportunities again. And so that concludes our discussion on beneficiation. I'll hand over to Chinmaya to cover fuel availability.
Okay, thank you, Devin. Now, as we all know, the Iran war that started from the end of February has significantly reduced supply of oil and oil products such as fuels coming from the Middle East. through the effective blockage of the Strait of Hormuz. And fuel, especially diesel, is important for open cast mining because it powers equipment and supports rail and trucking, both of which are needed to move materials and keep operations running. So I'll now be discussing how the Middle East conflict has affected fuel availability in South Africa. Firstly, how dependent is South Africa on fuel imports? Turns out quite significantly, as about 50 to 60% of domestic refining capacity is offline, as shown by this pie chart on the left, meaning that South Africa is highly dependent on fuel imports, especially for diesel, of which over 85% is imported on average, and about 40% of petrol is imported on average. Then the question becomes, how much of these come from the Middle East? So for both diesel and petrol, turns out the majority actually comes from the Middle East, making South Africa highly exposed to disruptions in the Middle East. So looking first at diesel, in 2025, over 80% of diesel was imported from the Middle East, followed by India at 18%. Then looking more recently, in the first quarter of 2026, the share coming from the Middle East increased actually to 87%, with that coming from India reducing down to 10%. And throughout this period, of the Middle Eastern countries, Oman, which lies outside the Strait of Hormuz and is less directly affected by the blockage, has been the biggest supplier to South Africa, accounting for about 40% of supply. And while official government data on imports for April and onwards are not yet available, it is possible to track shipping data to get an idea of where fuel is being shipped from. And from this, we see that for April and May, South Africa has been importing significantly more fuel than before the war. And of the fuel imports, more diesel is coming from the US, India, and Europe. Then moving on to petrol, in 2025, over 60% of petrol is imported from the Middle East, followed by India, with a portion coming from India increasing in the first quarter of 2026 and actually reaching to similar levels as the Middle East in March at about 37% of imports. And again, using shipping data to track imports, it shows that more petrol came from Europe, India, and US from April onwards, which is similar to the trend seen for diesel. And besides the direct imports of fuel from the Middle East, another way the Middle East war has disrupted fuel supply is through the imports of oil. Because even though South Africa imports less oil directly from the Middle East, with Nigeria and Angola being the major sources in recent times, given the current oil shortage, South Africa is still subject to global competition for oil cargoes from these countries. Now, the next question becomes, how have prices reacted to these supply shortages? So, following the start of the war, diesel and petrol prices have risen notably across Africa, with South Africa seeing the second highest jump in diesel prices on a percentage basis, as shown by this chart on the left, and the sixth highest jump in petrol prices, again on a percentage basis. And these are both despite the 3 to 4 rand per liter tax cuts implemented by the government. However, half of these cuts are going to be reintroduced in June, where these two graphs show how the South African fuel prices have moved so far this year, with the June price just being an estimate as official prices haven't yet been released. But the main trend is that prices have notably risen since the start of the war. However, some relief is finally expected for diesel in June, with prices expected to decline, as shown by this graph. However, petrol prices, on the other hand, are expected to continue their rise even into June. Then finally, the last piece of the picture regarding the fuel situation locally is how much fuel is present in South Africa's strategic fuel reserves. So there's an estimated 8 million barrels of oil in the strategic reserves, which equates to only around 2 weeks of supply. And while the government insists there are no fuel shortages, from our discussions with industry players, we've heard about companies being limited in how much they can buy, and some experiencing difficulty in getting product to rural areas. Therefore, South Africa remains very exposed to the Middle East disruptions. And for fuel, supply tightness and elevated prices are expected to continue into the near future, even if the strait opens up soon. And South Africa will have to walk a very fine line to keep prices manageable. I'll now hand over to Vinesh to address any questions raised by the spectators.
Right. So we have quite a few questions. So I'm going to get us started on this. And maybe one of the simplest ones here, a question of rigidity. Why is Eskom being so dogmatic when it comes to this process with the electricity tariffs? Maybe let me just start with a bit of context for those of you who aren't aware. Yeah, while Eskom set out this 62-cent tariff, they have to go through a process with NERSA. They have to hold public hearings. Why do things move so slowly? A lot of that is simply the way that the South African Electricity Act is set up. I think everyone involved recognizes the benefit. I think Eskom has come out and said they want to sell this electricity. The chrome producers have certainly said they would like this cheaper tariff. Unfortunately, these things do take time. That is simply the way it goes. So as Charles pointed out, we've got a government that seems to be more pro-business now. We've got more electricity. We've got an Eskom that wants to sell electricity. But the process, simply the steps required can move a little bit slowly on that, unfortunately. So that's the way that one goes.
And also, if I may chip in there, Vinesh, it's not only that the electricity tariffs impact the smelters, but that it impacts Eskom's business model altogether. So it's not simply a question of granting these guys lower rates to allow them to ramp up. That means lower revenue for Eskom in the longer term, and that means less investment on their behalf and potential electricity tariff increases for the rest of us. So it's not just a simple process.
True, Charles. Thank you very much. But it does seem again like we're on the path towards these slightly cheaper electricity prices. Maybe on a similar path, Devin, there's a question here around met alloys, the manganese player. What are we seeing happening over there?
Yeah, met alloys. It was South Africa's largest manganese alloy smelter back in the day. For those who don't know, it is processing through early stage redevelopment processes, and this follows the acquisition last year by Kwela, with plans to gradually refurbish and recommission the complex to restore domestic capacity. But there's been no confirmed restart date yet. So this is more viewed as strategically important, but we're hoping that these interventions from government and Eskom can allow this restart to take place. But currently, no furnaces have restarted.
Okay, so interesting. Government looks very focused on chrome right now. That's the deal that looks close to done. Hopefully, we see some relief on the manganese side a little bit later. Maybe switching away from electricity towards rail here, there's a question of private security on rail. It's a solidly interesting question. Where will the state find all the security for these extra railway lines, or will they look to private side? Maybe the one thing I can say is, again, while government has previously been opposed to certain private players, we have seen a government that is more willing to work with the private sector now. And particularly on the coal railway line, we saw coal companies working together, spending money to reduce cable theft, to spend money on security over there. So maybe now we are seeing a little bit more willingness to work with the private sector on improving things. All right. Then a question around the electricity space over here, about lots of IPPs being solar powered, a lack of batteries. I think that is certainly true. Not a lot of battery power on IPPs. What is Eskom doing? Well, as we saw earlier, Eskom's keeping a lot of coal-fired power stations online, which again helps to balance out the electricity. And for that instantaneous demand, we do still have Eskom has the diesel-powered turbines, and they are looking to convert those to gas. So again, that can help to respond if there is a lack of electricity generation, particularly as you point out into the evening here. Eskom can spin up diesel at the moment, and longer term looking into some gas-fired electricity over there. All right. Then a question on export share of minerals versus domestic use over here. For the big four. So maybe if I ask Devon in terms of iron ore, how does the volume of iron ore exported versus used domestically look?
Yeah, our iron ore exports are considerable. Back in 2021, our biggest producer, Kumba, Anglo America's Kumba Iron Ore, they solely exported their product, and they are 67% of SA's production. So the vast majority goes to exports. You have smaller players, Afrimat and ARM, who will supply to some local producers like ArcelorMittal, but yeah, by far majority of it is exported.
And then I think the majority of our chrome ore is also exported.
That's correct, yeah.
Okay.
Mainly because of the weakness in our domestic beneficiation. China's increased their ferrochrome smelting capacity, so our volumes largely head that way.
Okay, so most of our chrome currently exported. Maybe with the smelting things can change. How does our manganese look?
Very, very similar situation. Goes mostly to China for their steel making.
Okay, and then on the coal side, as the question has pointed out here, Eskom is the single largest buyer of South African coal. Yeah, more coal is used domestically than exported. As things go forward, though, this question of will our miners still have an export market? I would say absolutely yes. Usually what I point out is that while India is building out solar panels, they're also using more coal. Coal is not just for electricity in places like India and Pakistan, it's also used to make steel and make cement. And China's using a huge amount of coal to make chemicals. So while South African coal is thermal in nature, it's not just for electricity, there's lots of industrial purposes. So that there absolutely could be, if South Africa can get the rail running at 72 million tons per annum, which is the theoretical rail capacity, we would probably sell 72 million tons per annum of coal instead of 50 to 60 million tons. And when the day comes that we remove the rail bottleneck, Richards Bay Port can export 91 million tons, and there are customers in Asia who would buy 91 million tons of coal. So absolutely there is an export market for coal going forward. All right. So another question of is beneficiation too little too late? Our expectation, particularly on chrome, is we have seen smelters come back online. And Devon, maybe, this isn't obviously a light switch. It's not a button that can be pressed, but we do maybe see some smelters coming back online.
Yeah, like I said, the line smelter is the big first sign. But Eskom and the smelters have said that this tariff doesn't guarantee profitability. It's more towards their break-even level. And this is where the partnership between the two industries, or the government and industry, really matters, because if this allows, or at least eases some pressure on those ferro alloy producers to receive funds to potentially find alternative production routes to reduce electricity costs. And then if profitability does come through in future, then that benefits Eskom, where they can secure some benefit there as well. So it is a fun balance.
Well, I think that speaks to sort of a lot of the questions here were around profitability. So certainly the tariff will help chrome smelters. With profitability, we'd expect more chrome smelters to come online. And again, that helps with employment. To Charles' point, the macro environment is looking a little bit better. So this is broadly a win across the way for South Africa. All right. An interesting one here. On South Africa being hit hard by oil and our freight disadvantage. So the question is around South Africa versus Gabon or Australia. Devin, I'm assuming that leans mainly towards manganese. Maybe talk us through, is South Africa at a bit of a disadvantage on the manganese market compared to Australia and Gabon, given the high oil price?
I think definitely. I think that the major factor there is that both Gabon and Australia have your higher grade manganese ore products, which tend to require less energy to process to get the desirable product. So these higher energy costs definitely make processing those higher grade ores more attractive. Definitely.
Okay. And then maybe also an Australian advantage. A lot more Australian manganese is moved by rail. Maybe South Africa's got a bit of a trucking issue as well.
That's correct. I think the logistics bottlenecks here in South Africa are vastly different to Australia. They have the biggest ports, the most developed rail infrastructure. So their logistics costs tend to be much lower. So again, that is where they, I think, outperform domestic producers.
Thanks, Devin. Maybe one for Charles on this exploration fund. Obviously, we are tight for time, but maybe if there's a brief outlook, how are things looking there?
Is that the question, Vinesh, about
well, go ahead. The beneficiaries of the exploration fund.
Yes. To the best of my knowledge, we have not had a list. More sort of information from people making comment in public. Most recently, Minister Matashe, who in his budget presentation indicated that there are 13 projects, rare earth minerals, copper, nickel, mostly. So we know this is sort of making investment into minerals that are critical for the global energy transition. So it makes sense that they are focusing on the less developed industries in South Africa.
Thanks, Charles. Maybe Devin, a question here around tariff support helps to lower costs, but are we seeing any talk of ore export bans as we've seen in some other countries? Anything like that in South Africa?
Yeah, I think the more notable one would be the chrome export ban that has been, I think, referenced over recent years. Our view was always this is unlikely, especially if beneficiation doesn't come back online. But now with these positive moves from government, it does look like future export bans could be a real possibility. Yeah.
Okay, so yeah, maybe if we get all the smelters up and running and we're actually processing all of our chrome into ferrochrome, government may restrict chrome ore exports. Devin, maybe something similar on the manganese side if we get all the smelters back.
Yes, I've not seen a comment on that per se, but it could very well be at risk as well. We do have majority of production and resources, so if we can gain more value from beneficiating itself, I don't see why it's not a possibility. Yeah.
Right. As we're coming towards the end of the session, I think I'll maybe just take one or two last questions. But obviously, do please, if you have any questions, do email us and we'll try and reach out for the ones that we can't get to. But Devin, maybe a question on the beneficiation themselves. There's a question here of, is it Chinese investment? Is it new smelters? Or are these tariffs mainly bringing old smelters back online?
I think on the chrome and manganese side, it does seem to be getting our old capacity back online, up and running. We are seeing with those 2 steel projects that I mentioned, those are China-backed investments. So we do still see other countries looking to invest in beneficiation, but I think the focus now is getting what we have back online. Yeah.
Fair enough. And there are many smelters currently idled to bring back online.
That's right. Yeah, I think only about 11 of the 69 are currently running on ferrochrome side. Yeah.
And then I'll take this one as a last one live on air. We've got a question around Messino Mercado Metallurgical Complex. I'm sure many of you have followed this project. This is 10+ years, going to be a huge integrated stainless steel plant up in Limpopo. As it stands in 2026, they are still in pre-feasibility. The question is around what stage of development are they? Very basic pre-construction work, some clearing, some road building, but no feasibility study yet. They hope to get there in 2026. If it is eventually built, it'll be an absolutely massive stainless steel integrated plant, coking coal mines, chrome smelters and everything all up in Limpopo. But as it stands, no, some early pre-construction and no feasibility study yet. Again, these things take time. That project is 10+ years in the making. But South Africa does have coking coal up in the region, and we have lots of chrome which can be turned into ferrochrome and ultimately produce stainless steel. As I said, please, if you are a client, do reach out to us. Part of Afriforesight service is interaction with our clients, so please don't be strangers. Do please reach out. And then similarly, the Afriforesight Explore platform is where we try and load up notes each day on interesting topics. Please do take a look at that. Just yesterday we did one on stainless steel, which is obviously heavily tied into this chrome space. So do please reach out to us if you have questions, comments, if you'd like to sign up, and please do take a look at Afriforesight Explore, where we send out our daily notes as well as where all of our forecasts are now available. That's the new platform for accessing our Monday morning as well as our forecasts. So at this point, I'd like to say thank you so much to everyone for coming out, and please have a great day further. Thank you and goodbye.